Good afternoon, Dallas, Fort Worth. Thank you for attending our program today. We're going to be taking questions at the end of this program, so please go down to the bottom of the box. You feel free to chat throughout the program. We'll field those as needed. All the Q&A down at the bottom. I'd like to go ahead and thank all of our industry investors for the year. We're going to thank Chandler Cabinets, DuPont Tyvek Weatherization Partners, Milgard Windows and Doors, First National Bank and Mortgage, and lastly, Kelly Moore Paint Company. Without further ado, I'd like to introduce you guys to Britt Fair. He's going to take it from here and give us a little update on the real estate market. Thanks a lot, Britt.
Thank you, Matt. Yeah, welcome everybody. I call it my Twilight Zone edition to the real estate FAIRcast, forecast, whatever you want to call it. But yeah, it's clearly been a weird year. So a couple of things. So first of all, I do like the interactive aspects of this rather than have this be just a long, boring economic type lecture. So definitely use the Q&A box. Misty is going to be monitoring that, and so we will be able to, chime in with real-time questions. Misty said she would chime in if she saw something that was very timely. Otherwise, we can also save questions for the end, which is also fine. But I do like it to be interactive. And then the other aspect of this is there's going to be a lot of data on here, and there may be one slide that resonates with you and might help you in your business. And you don't have to take photographs or whatever. I mean, we will share the slides with you. I'm going to give you my email address right now that you can send me an email and I will respond with a copy of the slides for you. And then I'll repeat it at the end of the presentation. But my email address is bfair@fairtexastitle.com. So first initial B, my last name Fair @fairtexastitle.com, all spelled out. Okay, so let's get on with the 2020 Twilight Zone edition of the FAIRcast. Let's see if I can get this technology going. So obviously this has been a unusual 2020 drama. I think we can all agree on that. Obviously the COVID-19 pandemic is first and foremost of all the things. We had the shutdown, we had the reopenings, we had all the different guidance changes. Don't wear a mask, do wear a mask. Well, maybe wear a mask. All the craziness. And again, it's really hard to blame anybody. Everybody's, for the most part, I'm going to say, doing their best that they can, but it's just an unknown situation. Government stimulus and piling on government debt. Is there another wave coming? We've been asking that question for a while. And now that kids are going back to school, I'm asking it again because I have 3 kids going back to school. And so anyway, that's just been probably the biggest wave in the 2020 drama, but that's not it. We also, of course, had the death of George Floyd, which seemed to be maybe a tipping point in some of the questions on race relations, on police, citizen relations. And that has led to the mass protests on a positive side, probably, but on a negative side, the riots and looting and the stuff that's happening now. Gosh, it's been in Portland for a while and some of these other cities, but now it's in small town Wisconsin with the latest police incident there. And so I'm not sure where that's going, other than to say that that was a turning point that this year has happened sort of coinciding with the 2019 pandemic. Then we got the murder hornets. I thought that was a joke, but it wasn't really. It's just maybe limited to small areas. We got the nation of Chaz and Chop, if you remember that episode in Seattle. Double hurricanes today. How about that? So, as you're turning your pages in the novel, wondering what's next, well, double hurricanes is today. I read ahead, saw that Godzilla is going to emerge from Monster Island. I probably shouldn't mention that because I don't think I'm supposed to be reading ahead in the drama. So I'll scratch that one out. But and sort of the final chapter in the drama is the 2020 election. which, gosh, I feel like this 2020 election's been going on for quite a while. And, as a fan of dystopian novels and conspiracy movies or whatever, there's lots of people alleging that the other side, whichever side is the other side of their political beliefs, is behind a lot of these things. And so anyway, it's a crazy year so far. And I would imagine that, I don't know how much anybody's reading on all this. We've heard the problems with the post office or whatever, but the 2020 election is not going to be over on November the 3rd. I think that's a fair prediction to make right now, that if we all remember the Gore and Bush election and the hanging chads and all that we are going to have very likely going to have drama beyond election day this year, with the counting of mailed-in ballots and the finding of mail-in ballots and the disqualifying of mailed-in ballots. And so anyway, I just think that that how 2020 can you get, that we are going to probably be going into December with that drama as well. So crazy year. So let's talk about kind of a lot of the economic stuff first, and then we'll get to housing and all that is impacted by the economics. But for the most part, a lot of this economic stuff is COVID driven. And you can see on this chart here, first time unemployment claims. We said it, just looking at all, I guess in a way you could look and say, oh, well, that's getting better. Only around 1 million new unemployment claims in the most recent week measured, the week of August 15th. So not quite as bad as the 7 million or almost 7 million that we had in a given week. And but it really is awful when you think of, okay, well, that 1.1 million in a week would have been an all-time record back 6 months ago. So, we were ginning along at 200,000, 300,000 unemployment claims each week. And then boom, we get hit with 7 million. And it really has just been consistently a lot of people still getting their pink slips and going on to the unemployment line. Now, on the positive side, that doesn't mean that all those people who have gotten pink slips and become unemployed remain unemployed. So a better way to look at this, maybe the following chart, which is the continuing unemployment receipts. So this is people who have filed for unemployment and successfully received unemployment, meaning, they weren't fired for cause, for example. So you can see that we went from very few people on the unemployment rolls to 25 million. And even though we have been adding new people to the unemployment lists, we have also been taking people off of the unemployment lists, and we've been taking more people off than we've been adding. So we're down from about 25 million people receiving unemployment to about 15 million people, which is still a really large number. And I don't mean to minimize it, other than to say, I'm gonna go back a slide, other than to say that this chart looks like, man, the unemployment rolls are growing by 1.1 million last week. Well, no, not exactly, because we are also hiring people off of the unemployment rolls. So it's improving, but it's improving slowly. And so I think, back a few months ago, we were talking about, what is the shape of the recovery going to be? Is it going to be a perfect V shape, or in this case, an upside down V shape, where we have a huge spike in unemployment, but then they immediately come back to work once we get the all clear sign? And clearly that is not the case. It is a slower recovery than it was the suddenness of the pandemic. So another way of looking at this is job losses by metro. So the Bureau of Labor Statistics each month comes out with their job gains or job losses, as the case may be. And so in looking at the 12 biggest metro areas in the nation, I sort of show what the percentage changes have been over the last year in terms of employment. And so you can see DFW has lost jobs, 3.7% of our workforce declined. But really, that's pretty strong when you think about it, when you compare it to basically every other major metro area. Only Phoenix, of the top metro markets, has been better than DFW. And really, obviously, this is very much related to how strongly the lockdowns were enforced. New York City has been super stringent on their lockdowns because they were the hardest hit. And, you can look at, I guess we always look at these things, and again, it's really hard to distinguish politics from economics in some cases. But you can see that the sort of as a general rule, the tighter the lockdown, there's a correlation between, generally the Democratic Party was more for lockdowns, and you could say they were more for health or whatever positive way to spin that is as well. But the Washington, Philadelphia, Chicago, LA, San Francisco, Boston, and New York generally lost more jobs because of that. So there definitely are trade-offs to lockdowns. Whereas when you think about more Sun Belt, Miami, Houston, Atlanta, DFW, Phoenix, I don't know, you can go Sun Belt versus Rust Belt. And anyway, but long story short, regardless of the politics, DFW, while I won't say we got away unscathed, we certainly have not. We all know people who have lost their jobs and lost their businesses and whatnot. But 3.7% employment decline certainly sounds a whole lot better than many of these other metro areas. Just thinking about the general economy and GDP, you can see kind of what the quarterly numbers were. We were generally in that 2 to 3%, or maybe 1.5 to 3% each quarter pace. So annually about 2% growth every year. And really that continued through, even early March. But then mid-March, we obviously had the all of a sudden realization that the virus was not limited to Wuhan and was coming here. And, we started lockdowns in March. And so the first quarter numbers, while really good through the first couple of months, tanked in March and then really tanked in the second quarter, down over 30% on the pace as far as GDP. So a really ugly second quarter there, which obviously makes a whole lot of sense when you lock down your economy. Obviously, we all know the biggest hit types of businesses and jobs very much were hospitality related and retail, basically things that required people to get out of their house, so restaurants and bars, hotels, concert venues, airlines, all those kinds of things, travel destinations. Those are the ones that, that you still think about as far as just basically went to zero almost for a period of time. And so even if you could go buy online at your favorite online vendors or whatever, for the most part, people were just sitting at home and not spending quite as much money. And that's what caused the economy to tank in the second quarter. So just closer to home, one of the other things that really happened, you can see the big dip in oil prices, which makes a lot of sense, right? A couple things happened, but from a demand side, if people aren't going to their jobs in the factories to build whatever, autos or airplanes or whatever, well, generally the factories are not running and not using as much oil. And in addition to that, there was a price war between the Saudis and the Russians. So we had a huge tank in oil prices. And I only bring that up because it really even hurt Texas, I will say, more than a lot of other places, because we have produced so much oil in this state. Now, fortunately, Dallas-Fort Worth diversified its economy pretty well after the 1980s meltdown. So really, the oil business hasn't been as much of a downer for North Texas as it has in the Permian Basin or the Houston area, which certainly are more concentrated in the energy sector. But we do have a lot of oil investors and oil money here in North Texas, and then certainly other aspects of our economy, our state economy. So for example, the University of Texas system and the Texas A&M system get a lot of funding from the extraction taxes of oil. And so when basically it becomes unprofitable to drill new wells, well, guess what? We do feel it a little bit here, and our state definitely feels it. We're starting to see a whole lot of energy-related bankruptcies, companies who levered up and got a lot of debt on the books, and whether from acquisitions or just trying to push the envelope a little bit on their capitalization structure. But now with oil down around 40, and it's been lower than that, so fortunately it's rebounded. I guess in a way, directionally, it's been a good rebound to 40, but that's not high enough for a lot of these companies to make good profits. And so we are starting to see a lot of energy-related bankruptcies. And I think that's going to continue over the coming months. So just sort of as a stopping point for a second, I tried to get as much of the depressing news out of the way because that frankly is very depressing, and you could pull your hair out from depression just thinking about the job losses and the businesses failing. And so is there any good news? And I think the answer is definitely yes. I think you all know it's yes. And really, the home building and real estate market in North Texas is one of the best places to be in business right now, despite all of that chaos and depressing news. So let's get to the good news. So the first thing I will say, and any of you who have heard me speak before know that I'm very hesitant to ever compliment any form of government, any government officials or government institutions, but I'm about to do that. And that is, I think one of the reasons, or one of the things that saved us in a way, or saved what could be saved in our economy, is the rapid and large federal economic response. And I mean all parts of the federal government. So, the presidential administration, the Congress, the Federal Reserve, really all came together, at least in some ways, to provide at least some initial monetary response. We had I think the point was that the government tried to induce an economic coma, meaning, hey, everybody immediately go home and we'll give everybody some money and give companies some money to keep people on the payrolls. But there really was no playbook as far as how to induce an economic coma and then how to revive the patient, so to speak, so how to get the economy going after they get out of the coma. So, I think we all remember the various stimulus things that they did do. They added $600 from a week to the unemployment rolls, which really was a large number in addition to whatever the states traditionally give. That $600 a week actually ended up being controversial because a lot of people alleged that it was keeping a lot of people on the unemployment rolls because they were making more being unemployed than they were making before. So that's why we have not seen that $600 renewed once it expired July 31st. People got the $1,200 personal stimulus checks. Obviously, not everybody got those. It was sort of dependent on income and whatnot, but I think it was $1,200 per adult and then $500 per minor children or something like that. The Paycheck Protection Program for small businesses, again, you can argue whether it's a good idea or a bad idea, and socialism and blah, blah, blah. And again, I'm always up for a good political argument, but what I can say is that I do know businesses that that was a lifeline that kept people on the employment rolls, and I think that was ultimately the intent, was to just figure out a way to keep people from going to the unemployment rolls and keep them engaged with their current employers. And then obviously there were some other big loans made to businesses such as airlines and other strategic businesses like that. But the Federal Reserve, I would say, is even a bigger player in 2020 as far as just the monetary accommodation they have made to the economy. what we always, in our industry, home building, realtors, lenders, title people, we're always focused on the interest rate situation. And the Fed has definitely done very accommodative work on trying to drive down interest rates. They've been doing more of this sort of, I guess, back to the quantitative easing. I don't know that they're using those words, but it's basically the same thing that they did back in 2009, 2010, getting us back on our feet after that economic disaster. But so they've been basically buying bonds, buying treasury bonds, buying mortgage bonds, trying to drive down interest rates so that buyers could take advantage of that and buy houses and buy cars and refinance their houses, whatever it is. And then they've just been providing lots of other liquidity to the markets, just trying to make sure that the banks are capitalized properly and not in distress. Clearly, banks have some bad loans on their books, but as long as the Fed is trying to stimulate them and make sure they have liquidity, then generally there's not the real fear of huge bank failure, domino falling kind of thing. I guess the key questions on the federal response, just to break it down, is it enough money? I think certainly it appears that there is agreement in Congress and in the presidential administration that more money is needed. It's just they can't agree on what form. And the Republicans, I guess, are balking at sending too much money to the cities and states and bailing out their bad decisions. But I do think that even those Republicans agree that people need money to put groceries on the table and to pay their rent and those kinds of things. So I think ultimately, I think there's a decent chance that there's going to be more stimulus money coming if they can figure out a way to get it done and not, in fact, if there was not an election coming in November, I'm pretty confident it would already be done, but everybody is posturing right now for the election. So that's really the only thing holding it up, really. The other question, if you think back to the last 2008, 2009 collapse that we had, there was a big argument that, well, there was too much of a bailout of the big banks, too. All the dollars went to Wall Street and not enough to Main Street. And so I think that's another issue that is going to be asked here. Have we set too much, the PPP program? Yeah, that wasn't Wall Street, but it was still businesses that were receiving those funds. And so I think there was a question as to whether or some people are always going to ask, did you give too much money to the PPP, or did you give airlines too much money? It's just, did you give the banks too much money? And certainly you can, the arguments being made are the 1%, the top, whatever. For whatever reason, we always talk about the 1%, but it's really even the 0.1%, right? The Jeff Bezoses of the world, whose net worth has skyrocketed during this pandemic. I'm not blaming Jeff Bezos, other than to say that that's sort of back to this question of, did it get to Main Street or did it get to Wall Street? So I think that there will be analysis for years to come on how did we do, and I think that's going to be, again, back to the did we support everybody, or did the money all end up in the hands of the rich and powerful? And last but not least, the question, and this may be a long-term question too, will inflation and high interest rates be the cost of us doing all this quantitative easing, of the Federal Reserve buying all these bonds and driving interest rates way down? My economics study, maybe I read old textbooks or something, but they all seemed at the time to point to, well, if you basically add all this liquidity to an economy, eventually it's going to lead to inflation and higher interest rates. So far, it has not. And so, maybe the economic textbooks were wrong, or maybe we need to wait and see until once the economy picks up, that all this money sloshing around is going to lead to those things. I am not sure, but other than to say that I think most people think eventually, yes, it will lead to inflation and higher interest rates, but I don't see that anybody's projecting that that's going to be the case in the near term in terms of the next couple of years, that may be a, oh, that's a decade down the road kind of discussion. So how effective has the Fed been? Well, the Fed has been super effective in helping drive down interest rates. This is the 10-year Treasury rate, and it's down about 0.7%. This is a 5-year chart that we're looking at. So you can see that over that 5 years, we've had some ups and we've had some downs, but this certainly is super low. But to give you a really even better perspective, this is a 150-year chart of the same measure, the 10-year Treasury rate. So you can see that this 0.7%, where we are today, I mean, we are basically, aside from maybe a few weeks ago, we've never been this low. This is all-time lows. So it's pretty crazy stuff. And obviously, with mortgage rates sort of following this same shape, the 10-year Treasury rate, we are at mortgage rates that are just unprecedented, and that has gotten home buyers and home refinancers certainly very excited about the opportunities that are out there to take advantage of these fantastic interest rates. Similarly, when you drive the interest rates down this low, well, that kind of ends up goosing the stock market a little bit. And so both the S&P 500 and the NASDAQ are at all-time highs. This is showing the S&P 500 over the last year. And you can see that it cratered 36%. And yet we're back from that. We're back to all-time highs it's just amazing to me. And the NASDAQ didn't really crater quite as bad. And in fact, has been on an even more impressive run, but the comeback of the S&P 500, I think is pretty remarkable. Here's a chart that shows, this is a 5-year chart. The previous one was a 1-year chart. But you can see that, it's almost like nothing ever happened from the stock market perspective. And obviously I show the stock market, it's an interesting topic, I guess, but from a home buyer's perspective, you think about your luxury market buyers, most of them are reliant on some sort of investment portfolio or stock options, or even their retirement accounts or pension funds or whatever that are all tied to the stock market. So I guess the good news is for those luxury buyers, the down payment money that they had saved up or were trying to save up has recovered. And so those people can actually have a chance to use that money to make down payments on luxury homes. From a home builder's perspective, the numbers from the Commerce Department are pretty amazing as far as, again, back to the recovery of housing starts, jumped 23% in July. I think what's even more impressive, really, when you think about it, is the jump in housing starts that we saw at the end of the year and really January, February until the pandemic hit. But the recovery is pretty remarkable as well. And, again, I think it's back to a supply and demand issue for homes, which we'll talk about in a minute. But I think, the home building industry realizes that, man, there is a whole lot of demand for single family homes. Well, actually for lots of these homes, maybe not even single family, maybe duplexes, maybe the small apartment units. Matt and I were talking before this speech, and he was talking about the sort of smaller multifamily properties and how much popularity they're gaining from people in the giant apartment complexes who want a little bit less density. And so really we're just seeing an interest in a lot of these products, but certainly a lot of the products with less density than what existed before. Just the 2019 stats, I won't spend much time on this other than to say that we in Dallas-Fort Worth, the home building business was already top of the market, top of all the metro areas. And so that's really probably not surprising to you. And of course, why is that? Well, it's because of the population growth, which probably is also not too surprising for you. But you can see there's Dallas-Fort Worth, Arlington, of all the metro areas in the country, number one in population growth over the last decade, at least according to the 9th year of the decade, 2019. And really Dallas-Fort Worth and Houston both are just way out ahead of the rest of the metro areas in the country. You can see the significant drop off there. So pretty impressive stuff. And really you saw then going into back to the previous slide, sorry, 2 slides ago, you saw going into January, February, and now back to July, just we're building even more homes than we were before. So population by county, I always like to show this just, so Maricopa County in Arizona, that's where Phoenix is number 1, and Harris County is number 2. But, North Texas, here we are in North Texas, and we see, our counties just aren't as concentrated, I guess, like Harris County is, or maybe as large square miles wise as Harris County. So we've got Tarrant, Dallas, and Collin County all in the top 10 fastest growing population wide and county wise in all of the country, and Denton County is not far off that list either. So really amazing population growth. So of course that makes a whole lot of sense why we're going to need all these houses that the industry is building. Let's see. This just color codes the population growth, and it shows that a lot of people are moving from the Northeast and the Midwest to the South and to the West, and you can see sort of the metro areas of Texas, North Texas, but also the Houston area and Austin, San Antonio, all at that 10% and higher percentage change over the most recent decade. So lots of growth there. And it's just same numbers, but just shown graphically. So when you want to talk about the resale market, before I really talk much more about economics or the home building, but I work a lot with realtors, as I'm sure many of you do as well. But one of the things that's pretty remarkable is what we've seen in the resale market, and I'm sure it's mirrored in the home building market as well, new home market. It's just those stats are a little harder to get than the MLS stats. So this is the MLS stats for North Texas. And you can see I went back, I started back in 2007. So right before the big mess of 2008. And you can see that, each year over the last few years has gotten a little bit better than the previous year, a little bit better. And so the blue line, the dark navy blue line, is this year. And you can see January, February, and even March, the home sales were setting all-time records. But then when the pandemic hit in March, people stopped writing contracts on these existing homes. Everybody, or I won't say stopped, but it certainly slowed things down. And so you can see the April and May closings, the dollar volume was way down relative to recent years. And that makes sense, right? I mean, home buyers were nervous, right? They didn't want to get out of the house. In many cases, they weren't even allowed to get out of the house. Like Dallas County, it was not legal for realtors to show houses that weren't already under contract. So made it really difficult, obviously. So the sort of late March and early April panic and everybody sort of freezing led to very few closings, or a lot fewer closings in April and May. But then sort of late April and early May, we started sort of coming to grips with the situation on the pandemic, and started, home sellers started thinking, okay, well, we're willing to let people walk through our house, and home buyers certainly were getting eager to take advantage of the really low interest rates and declining interest rates. And so you can see that late April and May showings led to a really high June, an all-time high in June of just over $4 billion closed on existing homes in June. And then how did we follow that up? Well, we basically just went up another $1 billion to close to $5 billion of dollars transacted. So you can see just the outlier of the last 2 months have been in the existing home sale market. So, and just sort of as a sense of comparison, not only was July an all-time high, it was up 39% versus the previous July, and up 82% over May, which was just 2 months earlier. So pretty remarkable, just the bounce back. And so why is that? Well, part of it was the interest rates, and people are wanting to take advantage of the interest rates. A lot of it is just the pent up supply and pent up demand from April and May. Normally uh, whatever the amount is that those fell by, but that lower than what they would have been without a pandemic. Well, those people still wanted to buy and still wanted to sell. They just got pushed into June and July. So, and really August too. We're seeing August as another really strong month. I wouldn't be surprised if August is higher than June. It won't be as high as July, but I think August is another really strong month of closings as well. It's been a really remarkable last few months here, and sort of that, like I said, that pent up demand. Supply is the real issue on the new home market. I didn't put this statistic on here, but I have it in my hand. And that is that in general, when you look at sort of the North Texas homes and sales by price point and kind of by price band, maybe $100,000 band. I mean, you basically have less than 4 months of inventory at all bands below 800,000. Okay. Generally, the market experts, the typical economic experts, I guess, have always said that about 6 months of inventory is your balanced market. And so everything below 800,000 is generally less than 4 months of inventory. And it's really probably closer to 2 months of inventory, all the way up to $500,000. And even your 800 and 900,000, you're talking 4 to 5 months of inventory. Maybe only over 1 million. Looks like we're at about 8 months of inventory, 8.5. So as of July 31st. So I think the point is that inventory is the real story here. It is way down relative to the amount of buyer demand, which is great news for the home building business because you are the supply. You provide that supply. The only problem is you can't just turn it on and turn it off. I mean, you have lead times, right? So, but the resale market also supports, the records that you are seeing on the new home market as well, because it's the same supply and demand factors. There is a whole lot of demand driven by various features, especially I would say interest rates, but also this de-densification and pro-suburbia. Those are two factors that sort of, they definitely relate to the pandemic. They also relate to the policing, what people have seen in big cities and the concern just about, if I live in this big city, whether it's Chicago or Portland or downtown Dallas or wherever, am I going to get, or the dangerous things that I see on my television, is that going to happen to me, or should I move out to the suburbs? So, I think that there is sort of, and then obviously I don't want to catch the COVID-19 virus in my downtown high rise. So some of those people have said, maybe my close quarters living with neighbors, maybe that's not really what I want. And so I think there has been sort of a switch in the preference to suburban, or at least less dense, less urban, and more toward, as Matt and I talked about earlier, it was not being in the 400 unit apartment complex. Maybe I'm going to be in the 6 unit apartment complex. So those are just some of the trends that we're seeing, and I'm sure you guys are seeing as well. As far as home price appreciation, Case-Shiller came out with their June report yesterday and showed that in general, the composite, sort of the U.S. national average, I guess, was up about 4.3% price appreciation year over year. The Dallas area was up not quite that much, 3.1%. There is speculation that those numbers were skewed downward and that the July number is going to be a significantly higher number. I saw speculation when the numbers came out that we're going to see something closer to 9% price appreciation in July. So that'll be interesting to see the big jump. And, I showed you I'll show you the previous slide again, but you can see even from June to July, that was just some craziness as far as demand out there. And so I think that that's probably going to be reflected in significantly higher price points and price appreciation in July. Now, whether that stays that high or comes back down a little bit, I don't know. But anyway, the June number says 3.1%, but I think most experts out there are saying that they believe that the price appreciation number is significantly higher than that and will be reflected much higher in July. So with that, I'm gonna go to my sort of summary points and predictions. Oh, actually, I have, before I do that, no, I want to go over some. Actually, one of the things I do follow and wanted to provide this to you is the Fannie Mae economists, and because I thought that they take a good look at the economy, but also about the housing market, and I wanted to share those with you beforehand. So the first thing is that Fannie Mae's economic forecast that just came out 2 weeks ago. They update it every month, but in the yellow font there, what I wanted to show you was that in general, the craziness of the GDP, first of all. So you can see that in 2020, the first quarter, we were down 5%. Then we had the huge jump down 32%, almost 33%. But what the expectation is, and so far what we've seen, is a really large bounce back in the third quarter. So we're smack in the middle of the third quarter now. But the expectation from Fannie Mae is that we're going to have a 27.2 bounce back as far as percentage. So then if you want to go to the far right of the page, you can see it just to the right of that yellow box. You can see sort of the overall trends when you go annualized. That 2020 looks like it's going to be down about 3.1% according to Fannie Mae, but then that we are going to have a first of all, I don't mean to minimize that. If we're only down 3.1% this year on GDP, like think about that. Think about where we were in the second quarter, down 32.9%. So if we can only end up down 3.1%, man, we're going to have a hell of a second half of the year to get to that point. And then their expectation is that next year will be a big growth year as well, 4.3%. The other big economic thing that, I think we all look at is unemployment rate. And so I showed that here in the red box, which shows that obviously we had super low unemployment in the threes for a few years in a row. But then when the pandemic hit, boom, we got to 13% unemployment. What appears is that we are going to be improved, at least according to Fannie Mae. Their expectation is that we are going to continue to improve on that, but it's going to be a slow process. You just don't immediately put all those people back to work. So, 9.7%, then 8.8. And so going to the right of the red box, you can see the sort of annualized numbers. But so basically end 2020 at 8.8 and ending next year 7.1 or so. So again, that's going to be slow improvement nonetheless, but it's not going to be such great improvement that we're back to the 3% unemployment rate we had. So how does this impact their housing forecast? Well, I included that on the next slide. And what I wanted to focus on here is, since I'm talking to a lot of home builders, look at the green box. So that is their projections for both last year as well as 2020 and 2021. And for new homes in green, you can see that they expect it to be fairly flat, actually slightly positive, 0.9% increase this year versus last year, which obviously is banking on a huge final half of the year of new homes. And then next year, a slight growth, 3% growth in the new home sales. On the single family and condos for existing homes, they're actually, despite the really strong third quarter that they're seeing and projecting year over year, the number still is going to be a little bit lower than it was last year, 4.5% down. And it's going to start growing slightly from there. So maybe 1.8% growth next year in the single family, in the existing homes, 1.8%. So not moving as fast as the new home sales. And then the other sort of interesting projection that I see on their housing forecast is the interest rates. And really that's probably a huge underlying factor in all of this, has to be, because that's what's driving a lot of this demand. And what you can see is that the projection that Fannie Mae has is that rates are going to remain super low. In fact, going to go a little bit lower than where they are today. So that the 30-year fixed rate mortgage will go down to about 2.7% and level out there around the second quarter of 2021. So if that remains true, well, then mortgages will remain super hot. And that's why they and I are both projecting that, we're going to have a really good year the rest of this year and into 2021, driven strongly by the low interest rate environment that the Fed has really been pushing for. So with that, now I will turn to sort of the summary and predictions. So general economic, obviously the hit was both super sudden and extremely deep. And that's a weird combination. If you think back even to the Great Depression, it was a really deep depression, but it didn't happen. I know we think of the stock market crash in 1929, but it didn't cause the suddenness of the crash that we saw this time with the COVID-19 lockdowns. So that was something that was really very unique this time, and something that we're having to combat, both the suddenness and the depth of the economic downturn. Obviously, the DFW job market has taken a big hit, but not as bad as elsewhere. That I showed you earlier that we were behind only Phoenix as far as the major metro areas, as far as our job. It wasn't great, 3.7%, I believe it was, but over the last year, our decline in the number of jobs, but certainly could have been a whole lot worse. Fortunately, and like I said, I don't usually give a whole lot of credit to the federal government, so I feel like when it's deserved, I need to give them their props. But the speed by which they acted at least got us to this far. Now, obviously, we're all going to complain about government, and we're all going to say they didn't do this right, and they did that too much, and this too little. But what I can say is that the fast response and the depth of a response, certainly has helped. Now, obviously, there will be a price to pay for those kinds of things down the road as far as our national debt and those kinds of things. But I will give them credit for at least helping to get the economy bounced back. They can't make people take vacations and travel and go to bars. And in fact, most places you can't go to a bar. But, again, the monetary stimulus and certainly even just beyond the congressional stimulus, but just the Federal Reserve and what the Federal Reserve has done on an accommodation basis certainly has kept borrowing costs low and kept our mortgage rates low, for example, which has really helped the home building business and the realtor business and the title business and all the people who own homes. And so anyway, that's been a very positive thing, I think. We're having a super strong third quarter. You saw in the previous predictions that this third quarter is just a big bounce back quarter. Obviously, a lot of home buyers are interested in taking advantage of the low interest rates, and as well as, some of them still think that they might be out there to get a good deal. Whereas, I think we all kind of realize that a lot of those deals don't exist because, frankly, the supply of homes is just so low. So, I guess in a way that's good for home builders, and that there is not softness in the market for sellers. There is the stronger side to be on right now is on the seller side. Home builder specific stuff. Obviously, I call it the catbird seat that home builders are in, because a lot of people are going to be relocating here. We've always had people relocating here, but think about it. If you're in California, and in fact, Misty and I were talking also before this process, and she was talking about people she knows that are moving in from California. And if you're in one of these places that are super high cost, and maybe all of a sudden people are wanting to, they're having to start over in many cases. Maybe they've lost their jobs or lost their companies or whatever their anchor was to some of these places: New York, California, Chicago, lots of places. Well, maybe people will be moving to DFW's land of opportunity for that fresh start. Like if something was holding you back from that move, you were contemplating it before, and then a pandemic happens, sometimes that dislodges the one anchor that is keeping you there. So I think that we're just going to continue to have a huge influx of these relocations to North Texas. And, then you get the concept of de-densifying, right? The huge, multi-hundred unit apartments are no longer as popular as the 10-unit apartments. Well, the 10-unit apartments are probably less popular than duplexes, and duplexes may be less popular than single family because, again, I think there is this idea of, hey, COVID-19 may make me want to appreciate having my own space. So again, change is good from the perspective of home builders and whatnot. But anyway, so I think that's one of the positives, I guess, for home builders is that there is this change in the trend toward de-densification. Similarly, the suburban markets where a lot of the home building has taken place is gaining a desirability advantage relative to where it was before. I think a year or two ago, we were all talking about densification, urban walkability, all those kinds of things. And I think this whole, not just COVID-19, but I mean, also the crime and police issues, city budget concerns. I think that the big cities have been hit harder financially with the problems of the COVID-19 and the crime and police and all those kinds of things. And so suburban markets where home builders are building tends to be, they're in a more favorable position than they were a year ago. And finally, sort of the new home features. A lot of people, the homeschooling or work from home, if you're all trying to sit at the kitchen table, it really makes it hard to get any work done. So home offices, obviously, maybe even more than one home office. Some of you guys are probably building in that, the usable kitchen versus, people used to have kitchens, but maybe never used them. And all of a sudden have started to have to use their kitchens more. So the features in the kitchen, or just the fact that people are starting to use the kitchens and use their refrigerators and warming drawers. And, I don't know what all the various trends are, other than I do know that using your home as opposed is happening a whole lot more than it was being used before. Bigger yard. I mean, shoot, that's an obvious one from the de-densification, but just people are enjoying the outdoor spaces even more than they were before. So I guess the point is, yes, it's been a crazy year, right? I mean, and we've had a lot of negativity, and frankly, we're going to have a whole lot more negativity, partly because of the politics, partly because it's in everybody's best interest, both parties' best interest, to stir up their base and to keep things stirred up, through election day. And like I said, my prediction is that even after election day, we're going to have the controversy because the ballot counting is going to be different this year with all the vote by mail and all the question marks regarding that. But from a housing standpoint, from a home building standpoint, a mortgage standpoint, title, realtors, especially here in North Texas, we are in a really sweet spot. And I think that, I guess last but not least, I'll say this. I was asked the other day about housing. People know I'm involved in housing, and I was asked, gosh, why would you be comfortable spending, all that money to buy a house? Look at all the uncertainty right now. And I looked at the person and I just said, well, what would you do with your money? Like what makes you feel more certain? Like, does anybody feel like the stock market, it's been booming? Obviously we showed that, but like, I feel nervous just thinking about it. Like, is the stock market really worth that? And the bond market scares me even more, frankly. How can interest rates stay this low? I don't really like the coupons that they pay now. And eventually I think rates are going to go up. So bonds wouldn't be a great place. So I think the point is that, when I look at that person and I said, look, yes, there are things about real estate, but I think that it's one of the best places to have your money right now. And of course, I am in the business and I focus on that, but I do believe that. So I guess the takeaway that I would say before we go to Q&A is that I'm going to show this. This is sort of going to be my philosophy that I share with people, is the sort of royal crown of keep calm and buy a house, because I think that is a great place to be putting your money, and certainly a good, we all need places to live, but I think from a investment standpoint as well, it's a pretty good place to be. So that was about as fast as I could talk. Now, I guess I will go to Misty and see if there were any questions that people had in the Q&A box.
I do have a couple of questions. The first is, would you agree that due to the low interest rate, the overall price may be less important?
Well, yes. So I think that's when you have a low interest rate. I mean, I think to most home buyers, and this is true, although, especially in the mainstream price points of, let's call it $500,000 and under, I think the bigger issue for most people in those price points is the payment, right? How can I afford this? What's my monthly payment going to be? How much do I bring home in income, and those kinds of things? So in those mainstream price points, absolutely, when interest rates go down, well, you can afford more house, right? I mean, that your payment for the same payment, you can get more house. So I would agree with the questioner in those mainstream price points. At the end of the day, though, when you start getting into luxury homes, I think maybe it's a little bit different, where people are they're not quite as worried about what's my payment as much as what kind of value am I getting. So maybe I'm talking out of both sides of my mouth, but I think in the luxury price points, yes, interest rates are still important, and you can probably ask more for your home, but they're less focused on what is the actual payment to what is the value, and value is better when you can get better financing, but it's not quite as much tied to the monthly payment versus their paycheck.
All right, we've got one more. Now, there are a couple questions in this one. So how do you see the family dynamic changing because someone is staying at home teaching their kids? How does that affect buyers that are single income? And are you getting current feedback from buyers or realtors about the importance of dual workstations in homes?
So I'll start with the end. So, I hear a lot of anecdotal stories. So I don't have any data about having two home offices. But I have heard, sort of those anecdotal stories of, in fact, I think one of the places I heard it first was we did a builder association realtor panel, and we had 4 agents on that panel, and they were all talking about how having multiple places to escape. Now, it doesn't all have to necessarily be your giant offices, but something that you could the home buyers could sort of utilize for that purpose, even if it wasn't the primary purpose for it. So anyway, I don't have any data other than to say that they all said that was something that people only in the last 5 months or so have really started asking about, because frankly, they were trying to get work done. The other part of the question was about work from home, and how does it all play in, especially for single income, I guess. Well, and again, I'm not sure if the word said single income or single person, because those are probably two different dynamics. If you're a single income, but you have a stay-at-home parent, the Leave It to Beaver model or whatever, then that's probably the only group for whom the last 6 months have worked well at all. When you start talking about homeschool, the online schooling, and especially when you start talking elementary school age kids, and just how impossible it is for them to learn online, it seems like. So that group has really adapted well to the pandemic model. But just talking about the sort of maybe the single parent who has kids, and working from home, it's been a disaster really. And I'm not sure that there's a whole lot that you can do from a home builder perspective, as far as preparing for that. I mean, obviously we talked a minute ago about having maybe more than one work area where people can spread out and have some privacy. But it's really, that's more of a politics question. But as far as a logistics question, as far as how are we going to be doing all this with the stay-at-home schooling and parents who need to work but yet kind of have to stay home to watch the kids or to help teach the kids, I don't really have a good answer for that. I'm not sure if maybe I missed what the question was going after. Did I miss the point of the question, Misty?
I think you got it.
Okay.
I think you answered it.
The point is, I'm not sure there's a whole lot that any home builder or realtor or mortgage lender or title person can do about that problem. I mean, I get why we may or may not be going, having to face whether we go back to school or not. And, politically we'll figure out whether we do or whether we don't. That the issue of how do you have people work while also teaching their kids or helping their kids with technology or whatever is one that I haven't quite figured out. And frankly, I don't know that anybody has. But that's, from a perspective of a home builder or a housing market perspective, I do think that goes back to, having a place, and maybe the kids can have it in their room where they set up the Chromebook or whatever the school has provided, and are able to work, at some sort of desk space in their room. But certainly having at least one office kind of in the house. And like I said, maybe a second one, or at least maybe a second place where a second adult can go close off and do a conference call or do work, certainly seems more important than it did 6 months ago.
Well, Britt, that was a lot of information. Thank you for condensing it and being very concise, threw a lot of data at us and certainly a lot for us to digest. So having that available.
Okay, I said one quick thing. I said I would give my email address a second time for anybody who wants a copy of those slides. So as a reminder, if you want a copy of the slides, feel free to email me at bfair@fairtexastitle.com, all spelled out, bfair@fairtexastitle.com.
Fantastic. Yeah, I mean, just having that stuff available online so that we can pick it back apart and get the data, the real data as of last month is really helpful to the market. All we can hope as a father myself of 5 children, 4 of them being very small, is that it doesn't last forever, because my wife will be drinking wine at 10 a.m. And for the model, we grew up in 70s and 80s where latchkey kids were, we were labeled that. And so it's who only knows what our children growing up in this market are going to be labeled moving forward. So, all we can do is what we can do in this market, and that housing has never been stronger. We have to be very, very thankful that we actually live in Texas, because we are unfazed in the metro, as far as in comparison to across the board. So can't thank you enough for just spending the time with us today. And thank you for all that attended, and just wish everybody well, and let's go build some houses.
Thank you.
All right. Thank you.